Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back to the Bullington Capital Report, airing at an unusual time this week, as there were some football games being broadcast. Just want to remind everybody, I've got a seminar coming up very quickly. It's actually Thursday, September 12th. There's no cost to attend, however, seating is limited. We're going to be talking about trade disputes and how that may affect your investments. Recently we've seen stock prices basically dropping sharply in response to the currency manipulation by the People's Bank of China. And when markets are volatile, it can be really tempting to react right away. The emotional impact can blind even the savviest of investors. I just read that right off my website, just so you know. So at the seminar, we're going to learn about handling anxiety caused by market fluctuations, as well as when you may truly need to adjust your investments. I can speak today. Anyway, so oftentimes when news breaks and markets turn really volatile, it's very tempting to want to escape and pull your money out of the market and go back to the sidelines. That's not a really good idea. That's actually never been a really good idea. It's an okay idea to review what you have, to review your holdings, to take a look at how you're allocated, how your assets are broken down between stocks, bonds, and cash. That's a big deal. That's going to have the largest impact on your portfolio's returns more than anything else. In fancy terms, they like to call that asset allocation. I just like to call it stocks, bonds, and cash. What are your percentages? Now, the stocks are extremely fascinating. Over the past 10 years, I've seen an unbelievable amount of change happening in financial markets. Very interesting. What I find super interesting is that people are so upset when the data that I'm looking at, the data that the economists I follow closely are looking at, when the data of the portfolio managers who have done extremely well over the past 5, 10, 15, and 20 years, the data that they're looking at is all looking pretty good. It's all looking pretty good. We're going to go through some of that stuff, some of the data. I've got a lot of slides I can show you exactly what I'm talking about. That's one of the hard things about radio is that you've got all this math, all these graphs. The graphs are easy to see when you're there in person. Very difficult to describe what a graph looks like and have people to be able to create a mental image on the radio. It's just a little tough. And it's one of the reasons that we do the seminars. And I don't know if I mentioned that, but the seminar is actually Thursday, September 12th. It's going to start at 6:30. It's at Tri-Seas Corporate College. This time, the seminar is actually up on the second floor on the opposite end of the hall from the room that we normally use. So if you're going to go to the workshop, heads up, it's on the other side of the building this time. It's very nice facility. It's actually a little cozier, so I'll be able to get closer. You could be able to ask more questions. And I think this is a really good time to be looking at what you're doing, how you're doing it, what kinds of things have a tendency to do the best in a really volatile market, why you probably don't want to be holding a lot of long-term bonds right now. And that's a big one. I think the biggest risk I see for the average person, it's not the stock market. It's actually the bond market. Yeah, bond markets have done very well this year because interest rates have gone down. When interest rates go down, bond prices actually go up. We'll talk a little bit about that at the workshop and why that happens. But everybody's been talking about this thing called an inverted yield curve. That's when your short-term bonds, the 1 and 2 year bonds, are paying more than your 10-year bonds are. And they're all talking about how that leads to recession. And it's been a long time since we've had a real recession, but people forget sometimes how deep the recession was, how large it was, and that, yeah, the recovery period probably should be longer because the first 5 or 6 years of the recovery was very, very, very slow. And now it's actually, the growth rate right now, by the way, is a lot better. It's improved. It's still not at the long-term average. Long-term average growth in the economy is higher than what we're currently experiencing, believe it or not. So there's a lot of stuff out there, a lot of misconceptions. We're going to try to clean a lot of that stuff up as well as we can. I've got a lot of nice slides that kind of explain it. Like I said, it's very difficult to use a slide on the radio, but when you come to the workshop, you'll be able to see exactly what I'm talking about. There are an awful lot of things, awful lot of really good things going on in the economy. One of the things, for example, America is on the verge of displacing Saudi Arabia as an oil producer. Think about that for a second. We're getting ready to displace these guys as the world's largest oil producer. That's pretty amazing. The trade disputes, all they are is disputes. When you look at the actual numbers, they're not that large. They impact some people. Obviously, any action, by the way, is going to have an impact on somebody. It was Isaac Newton that said every action has an equal and opposite reaction. And you know what? It doesn't just pertain to physics. It actually pertains to almost everything, particularly financial markets. Every action has an opposite and equal reaction. Sometimes the actions are acute, meaning they show up in one or two industries. Sometimes the actions are spread out amongst a large number of industries, which causes many of the reactions to go unnoticed because it's such a small percentage of so many. That's kind of where I would place this trade dispute, because the things that they're talking about doing are not really, I mean, they're big numbers when you think about it, though they're not that big in relation to our economies. And see, that's a big deal. If it's the economies, you're talking about the world's largest economy, over 22 trillion. So to put a tax on 300 or 400 billion is really not that much. I mean, it's not. You know what a trillion is? A trillion is 1,000 billion. Okay. A trillion is 1,000 billion. And when you're talking about 22, 23, 24 trillion, you're talking about 22,000 billion. So you're talking about putting a tax on 200 or 300 billion. It's not that big a deal. It's just not that big a deal. Is somebody going to get hurt by it? Yes. Does the media like to run out to their farms and bring cameras out? And yes, they like to do that. You know why? Because they have to sell ads. And that's I would hate to be in that position. It's just I would find something else to do for a living if I actually had to do that. So the reality is they're making a big deal about a lot of stuff that I don't think is all that significant. From an economic standpoint, it's not that significant at all. I've got a lot of slides on the monetary system. That's one of the things I keep talking about, and how that's, the inverted yield curves, the end all be all. It's not very accurate, by the way. It's not. And we can talk about that. We're going to talk about that. So there are opportunities in this market. There are the valuations on most stocks are relatively normal. And you're going to have people pointing out, well, yeah, but we've got record profit levels. Well, yeah, that's a good thing. Oh, but that might not be maintained. I'm not so sure. I'm not so sure that profit margins won't go up from here, because the profit margins that have gotten to this level have gotten there because of automation, AI, despite the fact that we have an extremely tight labor market. What do I mean by that? It's pretty easy to get a job right now relative to the way it's been in the past. Now, a lot of those jobs are not paying a lot. That is absolutely true. But a lot of those jobs are, and a lot of those jobs that are paying a lot are going unfilled because you actually have to have some technical skills to get those jobs. But we've got them. The jobs are there. If you've got technical skills, you can be put to work and you can make a nice living. And why doesn't the news talk about that? Because it doesn't sell ads. That's the bottom line. Yeah, really, it doesn't sell ads. Coming from a guy who used to sell ad space before I got into this industry. If it bleeds, it leads. I never really liked that aspect of the business, but reality is people will slow down and look at accidents on the highway, cause other accidents because they're looking at it so intently. But people have a tendency to stop and look at negative stuff. And they ignore the positive stuff. And the positive is, it's really significant. It's really significant. It's not just trade. And by the way, did you know that China is not our biggest trading partner? And I think there were, I think Canada, Mexico, and Japan are all bigger than China. China's like number 4, I believe. I'll have to double check that, but I'm pretty sure that they're not our biggest trading partner. And a lot of things that are going on right now, we've lost an awful lot of jobs over the years to China because of a lot of their trade policies. And I think the net effect of this whole thing is actually going to be pretty positive when all this stuff shakes out. I really do. And if you want to know why, you should go to my website, sign up for the workshop, or, you don't have to come to a workshop. You can always call, set up a complimentary meeting. It could be on the phone, it could be in person. We do these all the time. I get acquainted meeting. You've got issues you want to talk about, or financial, whether, investments, how to position your estate so it goes through as smoothly as possible. I have attorneys. I just actually I got my estate plan redone, and it's been long overdue, but that's another thing that we can talk about. I have an enrolled agent who's on retainer. If you have tax questions, I'm not allowed to give tax advice, by the way, and I'm not allowed to give legal advice either. That's why I have these people. That's why I have a network to work with. We also have people that work with us at the financial services firms that we work with. And they have specialists, tax specialists, retirement plan specialists in all those areas. It's nice to have a network, especially when that network doesn't have any vested interest in giving you information that's not helpful. And I don't even want to kind of go into that, but the bottom line is we're independent at Bullington Capital, which means what we're really interested in is what's best for our clients, because that's what's best for us. That's how I think all this business should have been started from the get-go. I've been doing it now since I think it was 2004 that I left the brokerage community to branch out and start on my own. And have had a lot of help, a lot of support along the way. I want to thank all my clients and the staff at the firms that we work with for all that, and my own staff. It's been an interesting ride, to say the least. And it just gets, it never gets old. For me, it's never getting old. I like the change. I like trying to keep up with it. Sometimes it's very frustrating, but overall, I would say it's been a very positive experience. I look at where we are as a country. I look at where the economy is. I think things are pretty good. It bothers me a little bit. I'll be honest. I'm always honest, by the way. But having interest rates this low and hearing talk of them going even lower is a little upsetting, because it's going to force people into the only investments that have a halfway decent chance of making any real money, and that's the stock market. And I know there are vast numbers of people out there who don't want to have to put their money into the stock market to get a decent return. They don't. So you kind of have two choices. You have to take something that's not going to pay a whole lot, CDs, government bonds, those equity indexed annuities, forget those. The expense ratios on the inside of those, you're better off in CDs, in my opinion. That's my opinion. You're better off in CDs than an annuity that's got the words fixed, not just fixed, but my mind is going to me. Fixed indexed annuities. I've held a license, that's a principal's license for an options principal. and a futures license. And I can tell you, there's no way to hedge a portfolio and still earn a decent profit except by luck. You are going to have to get lucky to be able to make a decent return, to make a return that's a few percentage points above what CD rates are. I mean, you're going to have to get lucky to do that. So you can try, and I know the pitches. I hear them all the time. I see them. If I ever see one that's actually pretty good, I'll let you know. And it's not all annuities, by the way. Some annuities are actually pretty good. They're very good, in fact. But it's not all of them. Got to be really careful with that. That's one of the other reasons that we offer that Get Acquainted meeting. You can bring your statements to the meeting, and I'll take a quick look at them. If I see anything glaringly wrong, I'll let you know. More often than not, I have to take a look at it. I have to ask you some questions, find out what your goals are. Can give you an overview of what we would do and how we would do it. And then if you wanted a more detailed approach, we just set up a second meeting. So that's kind of how that works. There's no cost to doing that. We offer introductory meetings all the time. If you like what we do, then, hey, maybe you become a client. If you don't, that's okay. We part friends. And so how does that sound? We're not low pressure. We are no pressure. I want you to do the right thing for you. That's a big deal. The fact that you can have peace in your own mind, the fact that you've got somebody that will tell you objectively. See, that's the thing about being a fiduciary. I want you to do well, but I want you to stay within what makes you comfortable, because if you're not comfortable, when you see the stock market gyrating, you have a tendency to want to jump out at one of the worst times you could. And that's not good. I don't like seeing that. I don't like seeing people that hurt themselves. And by the way, the answer is to try to get an idea of how much risk you're taking right now and how much risk you actually need to take to be able to reach your retirement goals or your income goals or just your investment goals. You don't have to be retired. What kind of risk do you need to take to meet those goals? And a good fiduciary can sit down, give you a realistic set of guidelines based on different types of portfolios and can explain those to you and will let you know what you're up against, and they let you pick. So when volatility happens, and that's the one thing that you can practically guarantee in the stock market, is that it's going to fluctuate, sometimes a lot. So if you're not prepared for that, or if somebody's saying, well, we can hedge this and that'll go away, and they don't really know what carrying cost. This is, by the way, this is what I would ask somebody who says they can hedge a portfolio or they can guarantee your principal, it'll never go down. Ask them what carrying costs are. If they don't know what the definition of that is, don't walk away from that appointment. Run. If you don't know what the carrying costs are, you don't know the first thing about that. And if you can't show somebody what those carrying costs are, you've got a problem there. Hey, I'm going to go onto a break right now. You're listening to Bill Bullington right here on 1420. Stay tuned. I'll be right back.
There is no ocean that can't be parted. There is no mountain that can't be moved.
Well, welcome back. You're listening to Bill Bullington right here on 1420 The Answer. I'm here every Saturday morning from 11 to noon and also carried on the Fish's website as a podcast, 955thefish.com. You can also find it on Apple iTunes, the Bullington Capital Report, or go to my website, Bullington Capital. You can find it there too. I've got a seminar coming up I want to talk a little bit about. I think we were talking about this for almost the whole first segment, trade disputes and how that may affect your investments. I think you'll be pleased because there's been a lot of noise about that. The market's been very volatile. By the way, in the summer, a lot of portfolio managers are actually on vacation. About half the money now, at least half that's in the stock market, are managed by individual portfolio managers or teams of people. And they have a tendency to take vacations in July and August. So there aren't, there's not a full staff there. And it doesn't take a whole lot of money coming into the market at 3:45 or the first thing in the morning to move it up or down like quite a bit. And I know that just doesn't seem like it should work that way. Unfortunately, a lot of things don't work like we think they should or we deserve. And anyway, that's just something that you might want to keep in mind. July, August, September, those are actually pretty tough months. Most people remember October's, if you're old enough, and October's actually not all that bad, except for those 2 days, the one in 1929 and then 1987. Those were pretty bad days. Anyway, and if you would like to come in and talk, just to talk about your situation, this is what I do. I help people. I'm an investment advisor. I'm a registered fiduciary. I have to work in your best interests. So we offer a free get-to-know-you meeting. Feel free to take us up on that. Feel free to sign up for the seminar that's coming up. That is Thursday. It is, September 12th. It's going to start at 6:30. You can go to my website to sign up online. It's free. There's no cost to attend. We're going to be talking about a lot of different topics, that trade disputes and how that may affect your investments. I'm going to go into a particular fund that I've had money in now for quite a while, mainly because I like it. I like it a lot. And it's done by a company called First Trust. And the reason I'm bringing it up, I'm not recommending this, by the way, because I don't know anything about you. For my clients that I know really well, I can make these recommendations, but this is just kind of an informational thing. I'm not going to talk about past performance at all. If you're interested in it, please give me a call. I can send you we used to call them tear sheets. I don't know what they call them today, but there's a sheet that gives you everything you need to know. We can send you a prospectus. But today, I'm just going to focus on the fund's strategy. I'm a big fan of math when it comes to investing. I think you go math over emotions is what I like to say. It's fun sometimes to buy stocks that you like. We're going to talk about that too. And actually the last segment in today's show, we're going to talk about that in more detail. But I'm talking about your real money, your forever money. This is the money that you've saved up that you're going to use to be able to supplement your income when you get too old to work or when you just don't want to work anymore. I hope you get there by the age of 50. But this being America, that doesn't happen that often. But if you did, this would be something I think you'd have some interest in. Anyway, this particular fund, it begins with the universe of stocks from this company called Value Line. Value Line, you've probably heard of them before somewhere. If not, then don't worry about it. But Value Line has this safety ranking methodology that you can read about if you go to their website. Just Google Value Line. Okay. So these guys start off with all the Value Line safety rankings ranked stocks of number 1 or 2. So they're the two highest rankings they give. They take that group of stocks, they get rid of the limited partnerships and the foreign securities. Okay, so foreign companies and limited partnerships are excluded. From that, they're selecting the stocks that have a higher than average dividend yield. Now they're comparing that to the S&P 500, and I think the S&P's dividend yield right now is about 1.6. So anyway, it's narrowing the list of stocks down by quality using the Value Line screen, and then it's looking for the dividend yield that's slightly higher than the Standard & Poor's index. When they get to that level, then they eliminate the companies that are below $1 billion. And I'll tell you, there's a little secret about that. The companies that are bigger, that are paying dividends, have a tendency to be a little more stable, not quite as volatile, not always, okay, but that's just a tendency. So then what the index does is they're going to equally weight each of the securities in the index. And they're going to rebalance that once each month because stocks move up and down each month. But see, when they do this in a fund, you don't see that. And you don't have to report all those transactions, those micro, pieces of shares. Any of you that know me know that I put together models like this for a while. and where you got the actual individual shares. The tax reporting on that was a nightmare. It was brutal. And you had these super long 8949s that give to your tax person. Well, one of the reasons that I've kind of backed off of doing that lately is because of funds like this. This fund's not actually all that old. The current yield on it, I think, is about 2.33, higher than CDs are, higher than the 10-year Treasury. And there's some other things that are really nice about that. I want to talk about this one in particular, where I can give you the prospectus. You can take home with you, and you can ask questions at the seminar. And if we sit down together, if you decide to take me up on that free get acquainted meeting, I will bring the information out. You can take a look at it. This is just one of the holdings that I like. The reason that I like this is not just because it's had a good track record. That's a big deal. It's had a good track record, so that's good. I can't really talk about track records, and I can't even tell you what's good or not, because so I take that back. I've got all right. But realistically, it's had. I think it's had very. I don't know how you call it. I think what did Ben Graham say? Satisfactory. Yeah, Ben Graham we used to say the returns would be satisfactory. So I like the returns. I like the fact that it's getting a lot of the income from dividend. I like the fact that it's equal weighted. I like the fact that they're screening for safety, all that kind of stuff. See, when the markets get rough, when they start to fluctuate, you can always go back and you can read that stuff. And then you can look at how that's done in the past. So you don't just see how it's done. How well it's done. You see how it's done. And that can give you an incredibly large peace of mind. You get a big boost mentally from looking at a method and saying, oh yeah. And then you can go back and you can pull up charts on Google Finance if you want to, on the fund itself, or Yahoo Finance, or if you've got a subscription to Morningstar, you can look that up. I've got one of those super duper subscriptions to Morningstar that's like it's over $10,000 a year, and I can find out all kinds of stuff. So I like to do that, especially when markets get rough. Sometimes it's good to go back and read, look at how the fund performed, look at where it is today, and go, oh, okay, I guess I can go back to sleep now. And that's one of my jobs as an advisor, is kind of remind you, yeah, you see this? See what we're doing here? And it's not like, they're stocks. I mean, it is like they're stocks. I started to change my whole sentence there. It's not like they're going to go down or have gone down and stayed down. And that's one thing that I'm pretty sure is probably not going to happen, that stocks will go down, they'll crash, they'll drop, and they'll never come back. Why am I saying that? Well, first of all, I have a big belief. I have a lot of faith in the economy. And this is a belief, by the way. I'm not allowed to guarantee anything in my business, but I'm telling you why I believe it. The valuations on stocks are not that bad. The valuations on stocks like this are pretty good. What do I mean by valuation? Well, valuation is just how much something is selling for versus what you think it ought to. And I don't mean what Bill Bullington thinks it ought to. I mean the financial services industry, the money management business. They have various valuation metrics that they use. And when you see companies that appear to be fairly priced, let me give you kind of a quick comparison. I've used this a gazillion times. If you ever listen to anything on my old shows, you'll know that I've had this on. But if you look at price per square foot in real estate, it gives you an idea of how stocks are how houses are valued in a particular neighborhood. And I've only got about probably 45 seconds before I have to take a commercial break. So before I can finish this, I think I'll just kind of pause here for a second, wait for the commercial break to come up, and then we'll come back and talk about valuations on houses and how that might actually play into the stock market. Very similar comparisons, not too difficult. And I'm not really sure how much time I have before I go to commercial break because I can't hear the music anymore. This is pretty funny. But anyway, I'm going to Okay. We're going to come back. We're going to talk about how you use this type of portfolio, how it might be better than a CD. You think about it for a second. CDs don't fluctuate, first of all, but CD rate is fixed. That sucker's fixed. They tell you what it's going to be, and that's what it's going to be. You get a good quality stock that's paying a dividend. As their business grows over time, they will raise that dividend. The dividend will actually go up. So it might start out at 2.3, but there's a potential that 5 years or 10 years from now, it's paying substantially more than that. So that's one of the reasons that dividend-paying stocks are so popular. It's one of the reasons dividend-paying stocks have always been popular, because if you go back and you look at even the S&P 500, a big chunk of the return comes from the dividend, and dividends that have grown over the years. That's one of the big advantages stocks have over bonds or CDs if you give them enough time period and you have a pretty good methodology. With that, I will take a quick commercial break. You listen to Bill Bullington right here on 1420. Stay tuned.
When night is falling, when fear is calm.
Well, welcome back. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. You can also find this on the Fish's podcast, 955thefish.com, or you can go to Bullington Capital. There's a version of it there. It's also available on Apple iTunes under the Bullington Capital Report. And this might be a good show to have a copy of at some point in time. We're talking about a particular one of the funds I like to hold in a lot of my clients' accounts. It's not for everybody, but for a large number of people, I think it's a good addition. We're talking about how it was a dividend-paying fund and how the funds are selected. When the funds are, how they select, not the funds, the stocks that are in the fund. How they select stocks is going to have a big impact on its performance and how it behaves in a volatile market. And this particular strategy I like a lot. The thing I really like about these types of investments is that they're clearly defined. They're clearly defined. You know what you're getting. I can pull up all the holdings inside the fund. I can see the description on how they selected these stocks. That gives you an enormous peace of mind when you're having market turmoil. When the market's fluctuating and you know how your stocks were selected, you know that they're solid companies, that they're paying dividends. You can go back and look at the past history. You'll just turn the TV off in most cases and go do something fun. So I would love for everybody to get to that point. I think it would be awesome if they could do that. Having said that, get to the workshop or call us up. Try to get in for that one-on-one get acquainted meeting. I can show you this as an example. Won't be able to go through all the funds I hold in that particular model at that particular meeting. We will, if you decided that you want to invest in it, I'll go through each and every one of them with you. Show you exactly how they're selected. It's fun. I like it a lot. Anyway, I'm going to actually come back to that at some point in time on future shows. And I'm going to spend the last 15 minutes talking about another methodology that's also based on math. This one does allow you to select some of the stocks yourself. So in other words, you're going to be subjective with a small portion of the money. Now, when I say that, subjective means you're going to put your own 2 cents in. And this is a project we're calling Look Out for the Bull. Look Out for the Bull is a website where we're actually teaching this technique. And it's all math, super simple. I mean, super simple math. But we're going to put this up because I think it's a great teaching tool. Remember, I was talking about how you should probably look at that fund or any fund that you invest in, how they put those stocks together. Does it make sense to you? When it does, when you go back and then you look at the past performance and you see how it's behaved, it's going to allow you to achieve a certain peace of mind. Okay. Well, this is one step further. This is, we're going to use math to select stocks from a pool of stocks, and we're going to manage these ourselves. And but you're going to do it with some help from Bill and Mike, who's the intern at Case right now. We're going to publish the list of stocks that have met all the criteria. That's basically math. Okay. So having said that, this site, if it's not up in the next 2 weeks, I'm going to do something drastic. And it should be up in the next couple of weeks. So here's the deal. On the Lookout for the Bull website, I think it's a great way to get acclimated to how stocks work. If you do this long enough, it is a really wonderful teaching tool. And the good news is you'll actually be learning a lot of this stuff on your own with my help and Mike's. So here's what we're trying to do with this. We're trying to teach risk control. I'm trying to teach people how stocks actually behave, because I am rarely introduced to somebody that understands just exactly how stocks behave. It's very rare. And you'll gain a better understanding of most people that do what I do for a living, because the vast majority of them have never managed a portfolio before. The vast majority of them. Not all of them. There's probably 20% that actually will manage money, that will select stocks. But even then, the stuff that I'm talking about is so old and was used by so many practitioners that are either dead or retired for decades now, that the younger generation's never seen it. And a lot of the older generation never really saw it, because when they were, younger, it was so expensive to do that they would stick to a form of investing called value investing, which is fine. That's absolutely fine. This is called momentum investing. It is different. It's a lot different. Momentum investing relies primarily on price movement. The things like sales and profit margins, those are considered, but they're secondary. They're not the primary thing. See, with value investing, value investors are looking at things like sales, profit margins, how they think the company's going to do, what the tariffs are going to mean. They're trying to figure all that stuff out by looking at those fundamental things like sales and profit margins and what might happen in the future, and they're trying to divine the future today. That's fine. That's how Warren Buffett invests. A lot of people invest that way. It's got a huge set of challenges. I don't have time to do that stuff anymore, which is why I use funds that are set up to do that kind of stuff for me, like the other one we were talking about a little bit earlier in the show. So I like to use a combination, and this is a teaching tool. It's a hobby that can make you money. I love picking stocks this way. It's the only way that I'll do it anymore. If I'm going to do a value-oriented portfolio, I'm going to find the fund that's going to do the things that I don't have time to do, but I know they're going to do it, because by law, once they put it down on that prospectus, they have to do it. They can't get around it without going to jail anyway. But so anyway, first set of instructions. If you want to make money, and you want to make money sooner than later in stocks, and you're going to use momentum, you should probably be looking at those stocks that are going up right now. Does that make sense? If you're looking at making money in a stock and you want to make it sooner rather than later, you should probably select from a group of stocks that are going up right now. That's kind of a big deal. That's why they call it momentum. They're moving right now. The second thing you need to do is figure out where you're going to be a seller. And it's what I call the 1% rule. I'm sorry, where you're going to be a seller and how much of your portfolio you're going to put in there. It's what I call the 1% rule. The 1% rule tells you that. And I'll just give you a quick example. If you're going to use a 15% trailing stop, which is kind of what we recommend on the website, I'll tell you a little bit more about why in the future. But a 15% trailing stop, not a stop limit order, a trailing stop. Some people call them stop loss orders. Except that when you're profitable and your stop gets hit, and never mind. So 15% trailing stop loss. Typically, I recommend, I only put 5% of my money of that portfolio, 5% of that portfolio in a stock with a 15% trailing stop. So you know what that means? What's 15% of 5%? It's like 0.75%. That's it. That's the risk to that portfolio. What this is really about is managing risk. The same way everything I do is all about. We do it in slightly different ways. This way is a slightly different way than the fund that we were just talking about. That fund doesn't have a sell stop order. It looks at how the stock's yields. The yield goes down when the share price goes up, and it makes adjustments based on that. It's math. So is using a 15% trailing stop and limiting your position to 5%. That's using math. There's no emotion there. Goes down, stop gets executed. That's the way it works. That's a much easier, much simpler way to manage a portfolio. And quite frankly, I think it makes it a lot more fun. I really think it makes it a lot more fun. So I've covered that a little bit. We'll keep coming back to these subjects from time to time. In fact, the Look Out for the Bull website, it should be up any day now. You'll have a chance to read that stuff, print it out. I'm going to put some videos up on it. Very short. Everything, it's not that complicated, by the way. It's not complicated at all. And then you'll have an opportunity to subscribe to the daily list. As I'm looking at one of them right now, I'm going to run the scan really quickly because I can, and I think it's pretty funny. So I'm scanning roughly every stock that trades in the United States, and I'm going to do it on the count of 3. And at the count of 3, I'm going to scan every stock, and this is what I'm scanning for. The capitalization, that's the market value of the stock's got to be above 300 million. That's pretty small, by the way. The 3-month relative strength, that means the performance over the past 3 months, has got to be in the top 10% of all those stocks. So it's got to be in the top 10% of all those stocks. Today, it has to close in the upper 25% of its daily range. Why? Well, because if it's closing in the upper 25% of the day's range, that means it's closing very strong. And we're looking for stocks that are going up, that are outpacing the market, that are still going up. The other thing that helps me kind of clarify that they're still under accumulation is the volume of shares that traded today is above its 90-day average. Okay, so I just described the scan, and for the last 90 days, that's one of the scans. I use a 1 month, a 3 month, and a 6 month scan. I combine all those. It's the same basic criteria except for the months that I'm looking at. And I put those all into one scan. That's where I pick my stocks from for that particular style and that portfolio, that portion of my money. By the way, I think it's only 15% of what I had, a little less than 20%. That I have doing this because this is not safe. If I get hit by a bus and nobody's there to make adjustments to that portfolio, that could be bad. Okay, that could be really bad. So I know everybody's thinking, well, how often does that happen? Well, hopefully it never happens, but just in case. So anyway, I'm going to run that scan, and on a count of 3. 1, 2, 3. Okay, it's done. Now, there are 30 stocks. That went through several thousand stocks that fast. I am so jealous of the young people in this country. Because you know how long this used to take when I was in my 30s? I'd have to wait until 11 o'clock at night so that I can download all the data that had been compiled and cleaned. And then it would take a couple of hours to download and run those scans. I literally would start it. I would go to bed and I would get up at 6 o'clock, look at the scans to figure out what I might want to buy that day. And now I just ran that whole scan in less than 10 seconds. I'm hearing I got about 2 minutes left. So I gave you a lot of material there. That material is also available on lookoutforthebull.com. That is a subscription website. That's a new business for us. If you would like to know more about it, that stuff is all free. I put that up there at no charge. And feel free to go there and check it out. Feel free to go to my website and set up an introductory meeting if you would like. There's no cost to that either. You can either come into the office or I can come out and meet you. Or we can just do it on the phone, whatever you think you'd like to do. And I'm good for just about anything. And as always, feel free to reach out with emails if you have questions, if you hear something that you've got some issues about. We'll be talking in the future about some estate planning stuff. I've just had to go through that myself, and that's kind of a big deal for an awful lot of people, and rightly so. I think sometimes people get the impression that all I do is invest, and that's actually just one of the things that we do here at Bullington Capital. So as always, I appreciate you listening to the show this morning. And again, feel free to reach out to us if you have any questions. I appreciate the Salem Communications, WHK, the station here, 955thefish.com that carries this show as a podcast. I appreciate those guys too. Very helpful. I'm going to actually want to take off now. I hope you guys have a good weekend. Have a great Labor Day weekend. Take some time off. Take a nap. Rest up. Give me a call. Anyway, thanks a lot for listening. I'm Bill Bullington here every Saturday morning from 11 noon on 1420. Have a good weekend. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420. The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.